Oh, well, here we are, folks. Thanks for coming on just before Christmas. Bit of a good show tonight with Tony. He's queued up, ready to come in a moment. I'll just let the pre-show run for a second or two and give people time to come in. Already seen quite a few people on. It was great to see you and some new names as well as some recurring names. Good to see. Just in terms of the doggies, they're sound asleep at the moment, facing a different way tonight, but still very much sound asleep, having had quite a few walks today. So there we go. And appreciate all those who are liking the post. Really appreciate it. Thank you so much. Really makes a big difference to what goes on. And there'll be plenty of time for questions. As normal, when I bring Tony in, he's going to share some of his thoughts, and then we'll move on to questions from there. But anyway, let me just take the pre-show off. I'm going to run the intro and we'll get going. Well, good evening and welcome to this live stream on the 20th of December 2022. Martin North from Digital Finance Analytics here. Great to have you on. Thanks for spending some of your Tuesday evening with us. Just before Christmas, everyone's busy, but glad to see that you'd made time for us as well. And just before I bring Tony in, as normal, I just want to remind you that we don't provide specific financial or indeed legal advice or property advice. It's a general conversation. We do moderate the chat, so please play nice, but feel free to make comments. This is as at the 20th of December 2022 if you're watching in replay. And if you'd like to ask a question or get my attention, use @WalkTheWorld. That'll put you in a separate queue, and that means I've got more chance of seeing your question. I've also enabled Super Chat, which means that you can get your question top of the list or indeed make a contribution to what we do here, which is always greatly appreciated. Anyway, without further ado, let me bring Tony in. Tony, hello.
Good evening, Martin, and good evening, viewers. It feels like it's been a long time, Martin, so I'm almost have those first show nerves again. So if I seem a bit nervous, well, probably I am.
Don't worry, you'll roll back into it very, very quickly. Yeah. I tell you what, it's been quite a year, hasn't it? Really has been a year.
I tell my clients it's been monumentally shitty, and this is my annus horribilis. And if I reflect over the year, it's certainly one of the worst I've ever experienced. And I say jokingly, I've never worked harder to see my portfolio halve. So that's what markets can do. And doesn't matter how right you are on fundamentals, sometimes speculators and the market in general doesn't want to know about you. And it provides us with that humbling lesson, which I try and teach to my clients, is to always take profits and don't get delusions of grandeur. And after this show, I'll go and give myself an uppercut.
Well, it is interesting. This is just the ASX 200, right? And it's just interesting because who'd have thought that basically right at the end of 2021, we were hitting a high. And then it's been down, up, and it's down, right? And that's pretty much a replay. And of course, some of the other markets around the world are actually even worse than the ASX 200. We've actually done relatively well because we hadn't had such a big run up before. If you look at the Nasdaq or if you look at the US markets more generally, they're significantly down. And of course, it's interesting because there were a few attempts to go higher through the year, but they've always got derailed.
Yeah, it's a case of the market will get smashed around. You have a relief rally, but our market has simply outperformed by not falling as much. We've seen extreme volatility on the US markets. That's set to continue. It's probably time to reload on those negatively correlated ETFs, but yeah, Australia has performed exceptionally well despite 8 interest rate increases in a row, the threat of higher rates. Financials have performed well, tech stocks, not so. But if you look at the list of stocks in the US in particular, your Metas, your Apple, your Alphabet,
Yeah, well, we'll see. And certainly there's plenty of stuff going on. Now, you've got some slides. Would you like to sort of step through those on the way in? Just a second. It looks as though, just a second, just 1 second. Hang on. Right, try again. So, yeah, that should now work, and we should be able to hear you.
We've got that?
Yep.
Yeah, I think it's worthwhile having a look at the late Roger Brown and his thoughts. And I know many viewers have seen these before, but he was a guy that obviously had a lot of experience throughout his career and has made some pretty ballsy calls. And he only has to be half right, really, in this disaster scenario. So I'm just going to flick through some of them. And if you look at on the 7th of November, he was talking about 5-year fixed rate mortgages. And I think that was spot on. And that time where you could lock in 2.25%. I mean, I locked in not far north of that. And now that, we're at that 6% level, and he's calling for a 45% correction. And that has been my call, and that I maintain that view. Viewers, I think that when we reach those giddy heights, I always felt that, that 40 to 50% correction was due with much lower interest rates. And that's, I think, sadly, Roger's going to be proven right. So he spoke about rampant speculation, and that's what we've seen. The world has been drowning in the biggest dopamine bubble of all time. I mean, this is like the dot-com NASDAQ stupidity on steroids, and this is extended to multiple investment classes from, property, Bored Apes, shit coins, altcoins, exchanges, stacking yields, etc. I think in a number of years' time, economic students and aliens are going to look back at us humans in 2022 and think, WTF, what drugs are we on to think that we can push asset prices to such stupid levels with interest rates at 0.1% in Australia? It's just complete nonsense. And that was quite sad when Roger tweeted that his 12-month battle with bowel cancer was coming to an end. And I certainly miss his views on Twitter. I know you put up his last show here, but anyway, that's another tribute for Roger Brown, and someone with the courage to come out and tell it like it is without fear. And unfortunately, I think he only has to be a little bit right. So there's a disclaimer. This information, as you said, Martin, it's general in nature. It is current up until the last minute. If you need advice, obviously seek it. I should make it perfectly clear that I'm a stock market speculator, so I will be talking about some stocks with forward-looking statements. Being a speculator and not a conservative investor that switched to cash, I've had a complete shocker of a year personally. I have to roll with that because some years I can have 100, 200% up. This year, it's 50% down. And it certainly does have that negative wealth effect because my son looked at my car, which is black. I stupidly bought a black car. And he said, when are you going to wash it? And I pretty much ignored him because the last thing I want to do is pay for a bloody car wash. And that's the wealth effect. And I think that's going to have a massive impact on the psyche of Australians. So I've actually updated this economic shitstorm slide, and you can see there that we have the soccer mum SUVs, we have Sam Bankman-Fried behind bars with the FTX scandal. One of his girlfriends there who knitted herself a patchwork quilt, who was running the show, helping him. But I think what we've seen now is with a number of asset classes falling, which I think is going to extend to the stock market. I think the FTX blow is going to have a serious impact on the psychology of anyone in crypto or NFT assets. And this could be positive in a way, which will get people back to bloody fundamentals and not these Ponzi schemes where they're trying to buy low and sell to a greater idiot. So I think that we are now in the eye of a shitstorm, and Christmas, is a time where we probably drink a little too much, we eat too much, we always have our New Year's resolution that normally starts on the 1st of March when we join the gym and go once or twice. But I think that's where we have this little ceasefire, where there's a lull. But looking ahead to 2023, I just don't see any way out of it. So we look back at some of the major events of 2022. We have the war in Ukraine. Obviously, much less television coverage at present. Some of those images on the screen, what's been happening. Ukraine are fighting pretty hard. Russia's suffered a number of defeats. And all we're seeing really is, in a funny way, he takes his photo opportunities and probably has a contract with Cotton On for tight green T-shirts. But that's what a shocking way to start the year. And I think celebrity-wise, probably one of the worst years I've seen, especially with the Queen. Obviously, Shane Warne came as a bit of a shock to everyone. Andrew Symonds, probably one of the lesser-known cricket stars as well. We managed to lose my favourite rock drummer in Taylor Hawkins. That disaster in Japan as well. So, and Olivia Newton-John, sadly, who seemed to be fighting cancer forever and a day, and she finally succumbed to it. So, along with the economic, the war, and we've lost some really good people over the course of this year, and it's still not over yet. And we have to remember the floods as well. We had those horrific bushfires, which are on the news every day, which led into COVID, which took over the news. But these floods are a personal, financial, absolute disaster, and these poor people can't take a trick. And I feel for those in Sydney that have had almost double their average rainfall, and those storms over east. And I'm not going to make any jokes because we're probably due for some shitty weather in Perth, but it hasn't come yet. But again, those images, terrible. So this slide's a little bit outdated. The interest rate chart was there at 2.60. Obviously now it's 3.1. 8 interest rate increases in a row. It's certainly going to hit the psychology of the Australian consumer. I think it's going to hit in a big way. There's talk about big spending over Christmas. I've instilled a total gift ban in my household. Some might say you're a Grinch. But, you just got to look at this retail stupidity. And I think it's a time for family. It's a time to appreciate what you have. And I think the expenditure this year might be proven to be on the high side, but I think it's all downhill for next year. And actually, less retail spending will help with the interest rate increases, because once we start to get weak retail numbers, the RBA might slow down, but don't hold your breath. Now, who'd have thought that this year there'd be such massive data breaches such as Medibank and Optus? Now these things are starting to become regular occurrences. It all goes out on the dark web. That's truly frightening. And it's a scary time, because if you look at stocks, Medibank probably would be seen as something more defensive, and you go through this scary data breach. Same with Optus as well. So again, that's going to be something that will probably come to the forefront again next year, and it just adds to the shit show of 2022. And now we go to British politics, probably long forgotten now, and I wonder how that lettuce is doing. But again, some of these economic decisions, going ahead with tax cuts, jeopardising economies, threatening to undo a lot of Europe. That was a major news story, and I know they're taking the piss there, but the lettuce certainly lasted longer. Now, we do have an energy crisis. It doesn't get much attention lately. My partner is Hungarian, and she talks to a mother in Budapest every day, and now she's talking about 40% food inflation in Hungary. I was there earlier this year. Prices were okay, but now by the time I get back there early next year, it's probably going to be just as expensive in Hungary as it is in Australia, which is ridiculous. I know they're shutting down power. They're going to have to close schools. They're running out of fuel, and the capital, Budapest, has been overrun by tourists. So they are doing it really tough in Europe. And I know that energy is certainly going to be a focus in Australia as pensioners decide whether to eat, take their medication, or remain comfortable, either cooled or heated. So again, it's a dire situation. And I know that I'm starting to get a little bit of bill shock, especially with the electricity. But I guess now you have to earn a high income to run the aircon. So I can't see next year being a wonderful year at all. I just think, you look at the RBA cash rate at 3.1, 8 in a row. Thankfully, the RBA does not meet in January. We'll probably get the increases will probably start again in Feb, just to knock us while we're down even more. But Philip Lowe came out, and it was a bit of a Clayton's apology about the no interest rate rises till 2024. But the bond market was certainly telling us otherwise for some time. Now, interestingly, I think I know Tarek looks at French's Forest property as a bit of a barometer for the Sydney market. And if you look at those declines, we're down just under 19% over 12 months. Similar level of decline in Belrose. So if these are the last bastions of the Sydney property market, we're in for a lot of trouble. Thanks to George from ITC for posting these, by the way. I took these off Twitter. But again, you look at those declines in Manly. I remember Leichhardt was the scene of auction stupidity, where you had bidders after property that didn't even have a garage or car space just to live in Leichhardt. Similar falls for Balmain. So these suburbs in the Daily Telegraph would have been seen as bulletproof. But once sentiment wanes, these suburbs can certainly come off. And if you look at Mona Vale, down 25%, now down to about $2 million. Similar falls for Narrabeen. And the Northern Beaches have always been viewed as a strong area for property, and I can only see these falls up. I think they're going to accelerate next year, and I think that certainly is going to have a major impact in property. So some interesting charts there. And at the moment, the Sydney property market is declining at an annual run rate of about 15%. That's courtesy from Chris Joy, who probably has been the most accurate forecaster in the country at the moment. So what I look at in a property frenzy is school catchment zones, access to cafes, access to the water glimpses. In a bear market, no one really cares about these positive factors at all. There's cafes everywhere. You're not far from decent schools. Since when now are there really bad schools? So we saw that frenzy, those auctions where buyers were clambering to get their kids into these good schools. But now, the gap's certainly closing in the quality of schools. There's cafes, as I mentioned, everywhere. You can get coffee everywhere. You can get those beautifully manufactured kids' play areas in new estates. So I think there certainly has been a push for all these amenities and benefits to justify, these ridiculous prices that people are paying. And I look at we had all those sea changes and tree changes, and I must say that Perth, the most neglected regional city in Australia, you hear all these excuses about how we're years behind, how there aren't enough jobs, how we're too far from anything. And I think that all these misconceptions have kept us as the cheapest capital city in Australia. There's access to jobs if you want one. I as I've mentioned many times, I just can't believe my luck to be able to live in Perth. I'm pretty much close to everything. I'm not stuck commuting for hours every day. But I must say there is a benefit to these long commutes, and that's listening to podcasts and learning. But it's a bit of a take on Qatar. But again, Perth, from my observations in my area, decent properties are getting snapped up, but it has been a normal property market for some time. Not too much in the way of speculation or excitement, but even on an historical basis, you could argue that Perth's still overvalued. But it's a beautiful place to live. I know that many sold up and moved to the country areas with this work from home culture, but I think that's going to change. People will realise that it's not the dream location, and happiness pretty much is with your relationships. So there is a little bit of good news. I'm looking towards what I do every year. I look towards the stock market. I'm the first to admit that this year has been a complete shocker. My stocks, I've had a few that have outperformed. We've switched capital there, but on the whole, a bit of a disastrous year. A lot of factors certainly outside my control. But what has held on exceptionally well has been gold and silver. We now have gold over $1,800 US an ounce. The Australian gold price has been dancing sideways around that 2,500, 2,600 mark. I still like silver as a more speculative precious metal / commodity. That's been trading, got down below $20. It's currently around $23 an ounce. So there is the view that once there's signs of a pivot, normally you get a bit of a relief rally in the major markets, and that will end up being bullish for both gold and silver. But forecasting the price of these, really, it's anyone's guess. But what I can see is that based on 5,000 years of history, declining trust in crypto and wallets and exchanges, I can see some of the speculative funds moving back into gold and silver. So it could be some interesting times ahead. And now for my Christmas specials. So what I've done, I have an extensive list of companies I'm looking at. The benefit here is that none of these companies really have performed this year. Some have outperformed by not falling as much. But what I've done is I'm going to give my quadrella with my best roughie. I'll do this for the biotech and mining sectors. So with no further ado, Proteomics International, they're trading about 87 cents. This is one of my preferred stocks for 2023. They have a predictive blood test. It's called ProMarker D, and this picks up diabetic kidney disease in those with diabetes up to 4 years before it happens. They have a letter of intent signed with Sonic Healthcare. Now we need that to develop into a proper distribution agreement, and that's expected shortly. So there is some risk with that eventuating. They also have a blood test they're developing for endometriosis, which affects 1 in 9 women and can take up to 8 years to diagnose. The early signs are certainly encouraging. And they also have an initial blood test for esophageal cancer, which normally follows from acid reflux. So this will pick this up. And that accuracy came in at 90%. So very encouraging, even though the major market will be for ProMarker D. NICE in the UK have recommended that ProMarker D be presented to clinicians. And if this is taken up, proteomics will certainly earn some revenue. As I mentioned, share price 87 to 90 cents. Morgans have initiated coverage with a $1.77 target. It's highly speculative. I've dealt with management of this company for a few years. It has run up from 20 cents, well over $1. They have raised money. They have a lab services business in WA, which generates around $3 million in revenue per annum. And it kind of keeps the lights on, so they're not having a huge cash burn. So the code is Papa, India, Quebec. Radiopharm, an IPO at 60 cents, pretty much rang the bell for the biotech sector, because since then it's just been one-way traffic in a southeasterly direction. It's been shocking, and I think it's a reflection of the biotech sector. They've announced positive imaging on brain mets, which was great news on the imaging. They've also recently put out news on the HER2 breast cancer imaging, where it can greatly detect tumours. This was also met with a market sell-off. And what really affected Radiopharm was announcing a capital raising amongst the good news. They do have a number of small molecules which will be entering the clinic next year, and it's trading around 10.5, 11 cents. And it does have one of the richest pipelines in the much beaten up ASX biotech sector. My third stock is Dimerix. Code is Delta X-Ray Bravo. They're trading around 15 cents. Now, Dimerix have a kidney disease drug called DMX-200, which is in phase 3 trials. They've recruited 72 patients globally. FSGS is a rare kidney disease that often leads to a kidney transplant. It does have orphan drug status. So that should get a readout on how well this trial is going towards the latter stage of next year. Dimerix are also looking at partnering with this drug should it be successful. And when you've got orphan drug status, you can commercialise them quite quickly if successful. So the risk reward, I feel, is multiple upside. If the phase 3 trial doesn't meet critical endpoint, where obviously you're going to get thumped, but it's very rare for an Australian biotech to be in phase 3 at that valuation. So that's my third stock, Dimerix. Narada has been one of the most frustrating stocks I cover. Code is November Yankee Romeo. They're trading around 14 cents. They are testing a PCSK9 inhibitor for high cholesterol. And they have announced that instead of just testing healthy volunteers when it goes into the clinic, they're actually going to target those with high cholesterol concurrently, and this could save them between 6 to 12 months. So there has been some discussions I've seen on social media on these PCSK9 inhibitors and in their role at slowing down the biggest killer of people on Earth. So certainly one to keep an eye on. They do have their traumatic brain injury drugs, which are also slowly progressing in the background as well, in line with the Walter Reed Military Institute of Research in the US. So I guess as diets are being thrown out, we all go for the comfort food of over the current period. I guess cholesterol and heart disease will start to come to the fore. And I think what I've seen in the market is that even though these biotech stocks, they're being decimated, let's be honest, I can't hide away from that fact. I think that if successful, big pharma have hundreds of millions of dollars and will certainly look to buy out some of these small biotech companies in Australia, which pretty much get zero attention. And for my roughie, Adalta, code is 1 Alpha Delta. They have AD214, which is looking at fibrosis. They have had some difficulty in working out the best way to deliver the drug. They are working with Carina in CAR-T cancer therapies as well, and they do have an alliance with GE Healthcare. The share price was up in the mid-5s. There was some decent buying. It's now in the mid-4s. But what they've done is they've managed their cash position quite well. They're well cashed up. They have multiple assets. And again, they're looking for partners. So overall, these would be 5 biotech stocks that I'm focusing on that do look attractive on a risk-reward basis and based on a terrible year for the sector. I don't think their valuations are stretched by any means, and these 5 companies have managed to maintain solid cash positions, because when liquidity dries up in the stock market, it's very hard to raise money close to the market price, and a number of them have to do discounts. But very, very happy with the potential of all 5 companies here. Onto the mining sector. Again, it's a multi-market. We've seen the EV stocks, those companies that have backdoored in rare earth lithium projects anywhere in Africa, Canada, the moon, deep sea, have done exceptionally well up until the last few weeks, where we have seen a major correction, particularly in the lithium stocks. And I think that correction was overdue, but I certainly don't wish those in the EV space to witness what we've been through in the biotech sectors, certainly this year. But my first stock is Maronan Metals. Code is Mike Alpha. I assisted in the IPO of this company. We account for about 15% of the register. Despite having a total gift ban for my kids, I bought them all some stock today, just small amounts. I guess you have a yearly gift allowance for your kids, and you always end up buying them more stock than what you intended to. But look, it's a copper, gold, lead, silver asset in Cloncurry, North Queensland. It does have 100 million ounces of silver, with the potential to grow through further exploration. And I think that at some point, even though we haven't had a off-the-charts gold or silver stock bubble since 1978, 1980, I think if silver comes in for more attention, speculators are going to target these ASX stocks with silver in the ground. So drilling to date has yielded some encouraging results, some great results. It looks as though the resource is going to grow. They are drilling a deep hole, looking for some more lead silver, Cannington style, as they call it. And that hole would probably be just over a kilometre down, targets 1,500 metres. Red Metal has been a listed ASX company for 19 years. They've maintained a tight structure. They do have some really prospective projects in their own right, but they own 50% of Maronan Metals. So there is an arbitrage opportunity between both companies. At some point, Red Metal does trade at a discount to its holding in Maronan. So that would be probably my biggest position and main hope for next year. Oryaman has been an annus horribilis for Oryaman, totally unloved by the market, certainly one of the most disappointing gold stocks I've been involved with. But what I really like about them is management, how they've acquired the Sandstone project, how they've upgraded it, increased the grade. But where Oryaman have struggled has been with capital raising, and the results of recent raisings have been certainly disappointing. And I know that management are looking to grow that company. So it can take a number of years. And what I try to reiterate to my clients especially is that for a gold company to grow, you often need gold price or industry weakness to be able to acquire assets that the majors don't want. And that's certainly allowed the likes of Northern Star and Evolution to grow. So eventually we will have junior gold companies become the next mid-tier, but you do have to be patient and they can take a number of years. Pac Gold is a North Queensland gold company which have the Alice River project, listed at 25 cents and went to $1 reasonably quickly. Again, when you have a stock that goes from 25 cents to $1, once you see $1, you can often think, well, this is going to go to $2. It went the other way. They're around 38 cents at the moment. It is looking like a decent gold project. They have had some high-grade results. It's 30 kilometres of strike. And I think that once the market picks up for junior gold explorers, I think they'll come to the fore. But again, it's a lesson for everyone that sometimes 4 times your money is enough with the benefit of hindsight. So the code on that one is Papa Golf Oscar. Eagle Mountain, this is a bizarre company. They are a copper story based, the project's in Arizona. It ran from 13 cents. I managed to raise some money for them at 13 cents, and the stock just went nuts. It went to about $1.35, but unfortunately, the time it took was less than 12 months, and no one likes paying full tax. So there was a little bit of pushback on selling that one, but it's been a terrible journey back down, and the stock's trading around 17 cents. They have raised money recently at 16.5. Charlie Bass, one of the veterans of the Australian mining sector, has thrown in money at 45 cents, 16.5 cents. Their copper results in Arizona have been fantastic. They are looking at refurbishing the underground, drilling from underground, and hopefully they get approvals for their Oryx exploration project nearby, which could add another dimension to the project. But I think that the forecasts are clearly that the world is going to need a lot more copper, especially for EVs and to get to zero emissions, and numerous mines have to be discovered, put through the environmental rigmarole and brought into production. So that would be one of my main copper stories for next year, coming off a stupid cheap base. And we all like a Powerball. This is Copper Search. Let's be straight. Risk reward is you either halve your money if they make a hit. It's your typical hero or zero stock with the targets they have. Peak and Denison in South Australia. Dermatalica was a junior copper company which just got taken over by AIC Mines, and they reported some encouraging sniffs of copper at Peak and Denison. Copper Search owns some great ground in this region, and if there's some further interest, I think there could be a bit of a land grab. And Copper Search have provided a number of shallow targets, a number of deep targets as well. They're well cashed up and they'll be swinging hard in 2023. So again, all these stocks are of extreme risk. I look at the risk-reward ratio on all of them. Good management, well managed, great potential, and they just need a market that's prepared to listen. So that's my mining quadrilla. I do have a number of other stocks that I'm interested in. Non-inclusion really doesn't mean anything, but we're seeing in 2022 that companies that do report an exciting drill hole have actually overshot to the upside, that they've run far too hard, far too quickly. And I guess the only way to really make money in speculation is to buy the stocks, and you need to ride it out. And I know many in small cap stocks in 2022 would regret their decisions. They probably wish they went to cash, but you can't get a little bit pregnant. You're either in or you're out. And to stop the press, I saw this story today on Twitter where an Uber driver has agreed to pay over $2 million for a house in Brampton, $5,000 mortgage per month. Now the interest rates are on a tear. He's now looking at between $12,000 and $15,000 a month, and the valuation on that property has been slashed. And I think that this story certainly isn't in Canada only, and I know that we've had stories of outer Melbourne suburbs with a similar scenario, and it just makes you think, why were they trying to flip this property before they had to pay for it? But really, what could drive the mentality of someone to put themselves in this situation? And I guess in every speculative bubble, they don't end well. The key is to realise that you're in a bubble, either stay put or sell out. But that's an horrific story, and I can see that only being exacerbated as this bubble bursts. So I know that many of you might be playing Locantro Bingo, but I thought I'd end the presentation with the following slide. And, I likened where we are, sadly, in the world. I know I have this saying, but it's pretty similar to being sandpapered to death by Dave Hughes. So sadly, I wish I could have presented much more positive news, but I think those on this channel are certainly of the realist variety. And thanks for listening.
Thank you, Tony. Very good. And you've ticked off a few in your bingo score, but there's a few more to come yet. We'll see whether we can knock them over yet later. But there's a couple of questions which came out of that. In fact, Cookie Boy earlier on asked about the junior silver and gold miners, and he was sort of suggesting that if the exchange rate drops, are those targets potentially of overseas investors that might actually see them as a bit of an opportunity? What do you think?
Well, the issue we have is that a lot of our stocks trade, they're penny stocks. So you won't see a lot of the large overseas institutions take an interest just yet. And I guess what can curtail international interest is the Vancouver Casino Exchange and what goes on in Vancouver and Toronto. So there's plenty of stocks to speculate on those markets. But I think the Australian companies need to raise capital. We need to break free of these trading zones. The last couple of months, it's just been a drip feed of it's a mild form of capitulation where a lot of our quality juniors are down in the dumps. They're not valued properly on the resources in the ground. But again, fundamentals, no one really cares about the fundamentals, but often the best takeovers are driven by ego and people willing to pay way too much for them. So at the moment, you'd be lucky to see local interest in some of these stocks because, I have a saying that low share prices beget low share prices, but there's just so much value. But we really need capital markets to improve because some of these companies couldn't raise a sweat on a 40-degree day.
Fair enough, yeah. And I suppose if you set it in context of an international set of markets where international investors are sort of playing off opportunities in one country versus another country, exchange rates and all those things, there's a lot of different opportunities out there, I suppose.
Oh, there's far too many markets, far too many casinos. But I think these Australian gold and silver companies need to find access to capital. We need to see higher gold and silver prices. We need to see the hot money return to the sector because at the moment, it's hard to see a gold and silver stock bubble because we're nowhere near it. But, you can tell sometimes when announcements, you can feel the rush, but now that dopamine hit certainly isn't there. And we need probably the comeback we require next year is greed. We need greed to make a comeback. We need speculators to feel good about what they own to try and make money again because what's happened on our market in the smaller stocks and with crypto has been a loss of trust. And that's going to take some time to repair.
Yeah, no, I think you make a very good point about the lack of trust, and certainly many people have lost their shirts or are near to losing their shirts, from FTX all the way through. One interesting question that's come up a couple of times from people is your perspective on the RBA, because we know that, of course, Phil Lowe in November last year said no interest rate rises until 2024 and then tried to sort of walk away from that and caveat and say, well, I didn't really mean it. Rates have been going up. The forward view from the market, if you take the ASX 30, is still up. So basically 3.77% next year and then not much lower in May the following year. So the market is saying rates are going higher and they're going to stay higher. What's your perspective, Andy? Do you think that's on the money, or do you think that we're going to see rates come down a bit quicker than maybe what the markets are thinking?
Well, we need to stop spending for starters. We need to see retail spending taper off. If you look at rates around 3.8%, I mean, you had this saying in The Big Short. I mean, that's bloody Armageddon. There's no way you can escape that. How the hell can anyone with an average mortgage of $800,000 afford repayments of $90,000 per annum on an asset dropping 40% in value? I mean, that's, it's beyond being sandpapered to death. So the RBA, he's basically snookered himself where the bond market was telling anyone that could look at the longer term interest rates could see that how could you keep the rate at 0.1? But the punchline was, Martin, that Lowe was preparing for 15% unemployment.
Yep.
And it didn't come. I just, you've got property in the eastern states falling at 15% annualised. I've showed you the charts of those bulletproof Northern Beaches suburbs. There's just nowhere to hide now. And I've certainly copped it as a biotech investor. This year, it's been brutal. What happens if the sentiment tap really gets turned off for property? It doesn't matter where you are. It doesn't matter which cafe you're close to that serves deconstructed Vegemite on toast. You're going to get poleaxed. And that happens in every market. And I can say it ad infinitum. I could live in Bondi as a police officer in Bondi. I could live in a unit. I owned the unit. I walked to the beach. I could get a wave. I could buy a coffee. But nothing's changed except for crowds and Chemist Warehouse. So I don't know. You're right about all this marketing. It's just bullshit to justify nosebleed prices. But I think the RBA, an apology to the public, those that took out mortgages, no, I don't. It doesn't resonate well with me. And one thing I didn't bring up in my slideshow was the fixed rate mortgage cliff. And I've got 4 years to work out what I'm going to do with my mortgage. Luckily, I fixed it for 5. But geez, it better be a better biotech market by then. Otherwise, I'll have to look for a second job. And the worry is now that we're fatigued. The Australian public has copped these interest rate increases. We're too scared to open our bills because we know that we're in for a bill shock. Let's have a couple of weeks off to drink a lot and be close to family. But I just can't see anywhere to go. And the RBA has been forced to play catch up. You look what's happening in Canada. You look what's happening in New Zealand. And today, the Bank of Japan decided that they want to move the goalposts as well. Look what that did. So, unfortunately, the only way out of this is to miraculously curb inflation to get all these costs down, or have the mother of all recessions and or property collapses. So, there's just no hope in the foreseeable future at all.
And just on that, I'm certainly sorry if people listened to what we said and then acted on that and now regret what they've done, said Phil Lowe. How's that for a non-apology apology, eh?
Oh, it's Clayton's. It's Clayton's. Probably some viewers are too young to know what Clayton's is, but, well, it's a drink you have when you're not having a drink. But, yeah, you do feel, I don't know how he's feeling. I guess, obviously, you've got all of Australian mortgage holders hanging on your word. You've got the smart people looking at the bond market saying, wait a minute, what are you on? But it's no good feeling when you make suggestions and recommendations and in the short term they prove to be wrong. So I don't know how he's going to cope with the stress, and I hope he has a better Christmas than a lot of other people. But I think it's a dire situation because we either have much lower interest rates, well, I can't see that happening, or we lose 50% of the value of our over-leveraged assets, which aren't worth it as much. So,
but don't you think, Tony, a lot of it is actually going to be determined by what the Fed does? Because to my mind, the RBA is sort of interlocked with the Fed policy rates directly and indirectly because of the exchange rate.
Exactly. I don't know. Obviously, he didn't take his cue from New Zealand, which acted decisively and started to lift rates when we should have. But again, if he can't align himself with the bond market and what the yields are saying, well, how the hell is he going to work out what the Fed are doing? I just don't get it. And I think that he'd need to brush himself up with how bond markets operate. And I guess he has a job to do, and thus far he's muddled his way through, and we're all paying for it. And it's the lag effect of these higher rates. And as I mentioned, I'm not out there spending. I think what I've done personally is cull a lot of clothes I'm not going to wear, go to charity shops, and think, well, I've just got to make do with what I have, regardless of the situation, because sentiment-wise, there's nothing really to feel upbeat about, Martin, and that extends to the RBA and mortgage holders.
Yeah, well, certainly it looks to me as though rates will go higher, and many mortgage holders are already in difficulty. But one of the questions I wanted to ask you was, if you look back over the last year, we had quite a decline in stocks, but also the bond market was way off as well. So it's quite unusual to have both, if you like, sides of the coin heading down at the same time, because the argument always is, well, if one goes up, the other goes down, so there's an automatic sort of correction hedge there. So it's completely failed this time around, isn't it?
Yeah, it has, and there's always the potential that we might think that gold and silver might come through a market correction and hold up. Well, normally they don't. When there's a rush for liquidity, everything will get smashed. So I guess you've got to look at that situation. And as I mentioned earlier, if the Fed looks as though they're going to pivot, then you might see a rally in stocks. But my view is that rally has already occurred and has been factored in. So markets certainly look ahead. There has been carnage, certainly for bonds. But again, there'll be a point where people say, well, yeah, maybe it's time to re-enter. But there's no precedent for what we're experiencing. As I've said before, it's like trying to land an A380 without landing gear. I mean, who can engineer a soft landing from here? You can't prop up markets that are already overpriced at astronomical levels. You just can't do it, because as soon as sentiment shifts, doesn't matter what asset class you're in, it's just a rush for the exits. And unfortunately, I've had to experience that in the small cap stocks this year, but I've just got to stick to what I'm doing. But the major risk here is that it's on our most sentimental asset and we're over leveraged. And what the hell happens when investors start selling?
Yeah, well, it could well happen at some point. And I guess the other thought there is, with particularly the property market, because so much of the banking system is leveraged into property, sort of 65% plus the extra lending to the construction sector too. So the banking sector has a lot of skin in the game when it comes to what happens to property prices. And I guess the question is, will there be a few interventions? I'm thinking through COVID, of course, the banks started to be very generous in terms of, don't worry about repaying us, we'll give you a holiday for a period of time. Or, will we see the immigration dial turned up to try and bring more people in to support the property market? Or will we see more government intervention to try and prop up the property sector? I'm expecting all of those things, but I'm not convinced that necessarily it's going to be sufficient to quell the storm we're facing into.
Oh, I agree 100%, because as I ran through those so-called bulletproof suburbs, more downside to come, and you cannot stop forced sales. And no matter what holidays you give on loans, it's always capitalised. And it's a case of when does a couple sit down, have a serious discussion about finances and realise, hey, wait a minute, we need to sell. I think this Christmas period, as much as you enjoy it, it's a time where it's the ostrich approach. Stick your head in the sand, she'll be right. But hostilities are going to resume fairly quickly in January. I just can't see couples and families holding on when wages there's no hope for wages. A lot of the I mean, you can get jobs in hospitality, but when do you have time to sleep? So, this dream of living in Sydney, it's become a nightmare. So I don't know what levers anyone can pull. Obviously, here they've lifted the cap on Key Start, so you can now buy houses under 560. Well, you can get a beautiful home in Perth for around that price, but I just think it's too little, too late. They left the rate cycle too late. We've seen prices come off. There's nowhere to go. There's no wage growth. It's just a shit show, Martin.
Yeah, and I have one question for you, Tony, with regard to the property sector. Mandurah is a place I always looked at, and there was a lot of distressed sales and a lot of people in difficulty there. Have you got any sense of how those outer suburban areas are behaving in the West?
Believe it or not, Mandurah is getting some press for performing quite well. So it has bounced off the canvas. I guess it's benefited from the fact it's near the water. It does have a lot of positive attributes, but that area was hit very hard, but it's slowly recovering. So a lot of the outer areas of Perth are struggling. I live within 10 kilometres of the CBD. I keep an eye on what's happening around here. I go to a lot of home opens, not to buy anything, but just to get a gauge on the market. But Perth has been resilient. From the fact is that we didn't really participate in the speculative stupidity, and instead of heading west, the hot money went to Hobart.
Hobart and Adelaide, right? They were the two. They were the two most recent top markets, and unfortunately, both Hobart, which is falling quite fast now, and Adelaide, which has just started to fall. Both of those are actually being impacted predominantly by investors now getting cold feet. It's quite interesting how that's changed, and it's changed quite quickly. And I think that's an interesting observation, because if you look at Brisbane prices there have started to slide, and they've started to slide more quickly than in Sydney or Melbourne at the moment. So we're seeing some quite big sort of moves. Perth looks more solid because maybe we didn't have the run up, and maybe people are still thinking back to where the prices were a lot higher previously. But I just personally am not convinced that Perth will actually escape if in fact the interest rate shock that we see is going to hit the West as well.
I don't think there's anywhere to hide, and that you will have individual suburbs that will show up as the top performers. I know my favourite suburb in Perth, Mount Hawthorn, and the other one, Leederville, have been the two best performers over 5 years. But these are great suburbs that probably have aspirations to turn into something like a Strathfield, where you had people trying to get into the school zones and paying $6,000 per bloody square metre. So you do have these blue chip suburbs in Perth. Mount Hawthorn, I think, has everything going for it, and the median price is 1.2. But there's very few properties on the market, and they get snapped up pretty quick. And the same goes for Leederville, which is a great place, and it's only 3 kilometres from the city, and it's just emerging as a cafe, restaurant, entertainment precinct with a lot more life than the likes of Norton Street, Leichhardt as well. And you look at what happened to property in Leichhardt and Balmain. So we have a lot of catching up to do, but no, we won't be immune from forced sales. There is quite a shortage, a labour shortage here, but those jobs are mainly in hospitality as well. But obviously, there's plenty of FIFO jobs where the pay's still decent, but again, it's a lifestyle choice. So, yes, we've held on for now. However, we certainly won't be immune, and there are the mortgage prisons, I call them, and they're more 50 kilometres from the city, but it's a mortgage prison by the sea. And I know there's a lot of places in Australia that would be classified as that. So Yeah, interesting market. As I said, there's always going to be pockets that will outperform. You'll have lists, in newspapers saying, well, these are the up and coming suburbs. But I still think it's a continuation of the carnage into next year and beyond.
Yeah, and certainly in my surveys and stress models, I see quite a lot of stress on that coastal strip north of Perth in particular, where there's been massive amounts of new development and massive new suburbs with not much infrastructure and all the rest of it. So I think that's going to be a place where there will be some grief ahead. But one question I had was lithium. I've been reading, the diversified view. So some people are saying lithium's way overhyped. Other people are saying it's the future, and everyone's going to need lithium because it's going to be part of the the next revolution in terms of energy and everything else. How do you read the whole lithium debate?
There's no shortage of it. For starters, I think I have to go back a little bit, but there's apparently 1,400 years worth of it on the Earth. Small cap companies with no projects can easily find a lithium project. So it has been a bandwagon. So the sector has done exceptionally well. Those in the lithium stocks following that EV thematic have certainly smashed my portfolio performance-wise. But the last month or so, some of these stocks have lost 30, 40, 50%, and sentiment is starting to wane. And you've had like Goldman Sachs and others come out and say, well, it's all overpriced. So the debate is certainly going on. I know Pilbara got less at their auctions than what was anticipated. They've been sold off. You've had stocks such as Liontown, which was trading at 2 cents, went to about $2, and they've just started their correction. I think they're now down to about $1.35, but still well up there. But some of these market caps into the billions and no signs of production. And I go back to the lithium bubble of 2008, which I was involved in. We had two stocks to choose from, Orocobre and Galaxy, which is now Alchem. But I think there will be some pockets of strength, but the way it's looking, I think those that are firmly in the EV camp are in for a tough year, and I'm just hopeful that it's not as bad as what's happened to the biotech sector. But the share prices are already saying that interest is waning. You will have small companies that will find a lithium project out. It will give about a days of excitement. But again, it's like you're late to the party. The party's ended at 3 a.m. and you rock up holding a vegan pizza. It's too late, and it's how spec bubbles operate.
Yeah.
You have uranium companies in the last uranium bubble. They backdoor in a uranium project, but none of these, very few companies come out of a speculative bubble and get into production. Same for the tech, about profits. Same about any other bubble. So I really hope that some of these lithium projects get into production and shareholders are rewarded. But the last month certainly would suggest otherwise. That I guess you believe in the story, you hang on. I've certainly been guilty of that in some of my stocks, because once you're on the nose, you tend to stay there. And you can have the best fundamentals, you can have the best ocean views, you can have everything, but if the market doesn't want to pay for it, you head south. So I guess in a way I have order envy with lithium this time around. I got the dry chicken breast. The investor next to me got the perfectly cooked steak. So I'm going to have to live with that, but geez, it's tough out there.
Absolutely, yeah. Well, things change and things stay the same, right? The difficulty is you don't know quite which way it's going to go. That's the problem.
Yeah.
I mean, there's been an amazing amount of hype, but also amazing amount of arguments the other way. I made a post the other day talking about the markets are more marketing than actually, real market analysis. And in fact, the truth is that those people who are doing really good market analysis probably won't want to shout it from the rooftops, whereas a lot of those people who are actually shouting it from the rooftops are more about positioning and more about showing that they, have got a particular reputation to protect, etc. So there's something really weird at the centre of all of this that actually determines, I think, that you can't necessarily take at face value what people are saying about, lithium or anything else.
No, and that certainly extends to the sandpit I play in. Everyone can be playing happily, then suddenly all the toys get thrown out. I look at the marketing for crypto. I was actually at the shops a couple of months ago, and there was a young girl in her T-ball uniform, sponsored by Hex. I mean, she had the Hex symbol on her back. I mean, it's taxis all over it. Richard Hart did an exceptional job with Hex. So you're right, it's all marketing. And then now you have to look at the Trump NFT cards.
$99 US, eh?
Well, they've sold out and they're now on the market. You could pay overs for that, or you could have paid $42,000 for a Taylor Swift ticket. I think the older you get, the more cynical you become, and you realise 99% of everything's just complete and utter bullshit. We are all victims of consumerism. And, I've learned now, I'm 51, that, yes, there's no shame in driving a dirty car now. I don't care. I don't need to go out and prove anything to anyone. My house has no street appeal. I just enjoy my own company, whatever family left that will talk to me. So you do come to this realisation that things only have real sentimental value, or any value, if you can afford to hold on to it. And I now know that I certainly feel a lot less wealthier. Well, I am. And now I'm looking at stuff in my house that hasn't been opened, that I can start to sell just to feel a little bit better. And now it's a case of, well, I need the determination to work a bit harder to get back to where I was. And next time, get rid of these delusions of grandeur and do the smart thing and prepare for later in life, because we're all running out of time.
Yeah, time is the one commodity that is not infinite, I fear. But there was an interesting question from Cookie about uranium, and we've been talking about lithium. Are you still bullish on uranium? Cookie Boy says. I can't remember whether you were or whether you weren't, but are you?
Well, the answer to that is I'd call myself neutral to bullish. And going through that uranium bubble of 2005, 2006, that was insanity. I then went back into the sector and we picked up a couple of stocks just in case uranium had a run. And the uranium price did very little, but the stocks went 8, 9, 10 times. And I said, well, wait a minute, something's not right here. So we got out of our uranium stocks, which was where clients weren't as greedy. And now I'm looking at these Canadian explorers where there have been some discoveries, and looking at the sector to have some hype. But I guess that hype has dissipated with, the Sprott Fund and everyone was buying into these stocks. But that certainly has run out for now. And I guess some of these uranium companies will have to get back to fundamentals. But at the moment, there's no real excitement now with the uranium acquisition in comparison to someone making a rare earth in clay acquisition, which tends to get that sugar hit for a day or two. But yeah, certainly I dare say I'm probably bullish. I do have some confidence in uranium. Will it get back to 2005, 2006? I'd say hell no, because those were the days where you had a handful of uranium companies, then suddenly you have 150. And we've seen that proliferation in every speculative bubble, Martin, and you make the exact point. It's all about marketing. So you can go to a mining conference, they've all got their images. It's like going to a South American swimsuit parade. This is an analogy I use quite a bit. They all look good on the outside, but you've got to work out the ones that can hold a conversation and aren't going to take 80% of your money when they divorce you. So really, it's tough to differentiate between what's real and what's heavily marketed. But a lot of the best investments you often don't hear about.
No, good point, Tony. And quite often, as you say, it's the quiet investments that nobody hears about, which are actually the ones that are really, doing the hard work. There's a lot of other stuff that's actually out there being hyped. And as I get older, I get more cynical too. But also, because I've been around the traps a bit longer, I have to say that I see more of those leading indicators, and you can sort of almost smell the bullshit, if I can use that word without offending anybody. There's a lot of stuff out there that's rubbish. I mean, look, you only have to watch my channel and see the number of property spruikers that take advantage of trying to hook their ads into my shows, right? I chuckle because, well, if they want to do that, I'm happy to get the revenue, I suppose. But the point is that you've got to actually understand that there are a lot of people out there spinning a yarn and trying to sell you stuff, right? And I guess there's a lot of gullibility, which I see quite often, because people sort of, one, take on face value what they're told, and two, they don't necessarily sort of kick the can on it and sort of pull it apart and think about it, right? And actually at the moment, more than ever, it's really important, I think, to really look at these things seriously and don't just take the top level spruik as being the truth. Yeah,
and the disappointing thing is we often don't learn from our mistakes. If I have a stock that goes parabolic, I'll then get delusions of upgrading my car, which is ridiculous because I'd be lucky to drive 6,000 kilometres in Perth. And you go through the wealth effect, and dopamine it's amazing that when you start to feel confident, you will go and spend a lot more money, and you will buy shit you don't need to impress people you don't like anyway. So I've tried to simplify my life, and the best investment I've made now is a $12 a week gym membership. And what I'm now trying to become addicted to is fitness and being able to walk away from this technology, get into the gym. I mean, to me, that's going to give me more personal growth than building up a property or share portfolio at the moment. And I guess, you have to get back to the simple things. And I've been scared of pain. I mean, the last time I seriously did a lot of exercise was in bloody police academy. Oh, God, 32 years ago. And now I finally realise pain, and I can go to the gym and smash that ball against the wall in anger at my buy-check portfolio. So that's my New Year's resolution. I've started already. This is an area where I like now to spend money. I'll go and get some exercise stuff. But, you go through these addictions, and it's all dopamine. It's all self-gratification. Prior to the GFC, I had more delusions of grandeur, so I bought 15 bloody guitars. So we all go through this, stupidity. And when I start to feel a bit better about my stocks, I'll walk past a house on 1,000 square meters and look at doing a development, and then I come to my senses. But unfortunately, a lot of that dopamine, the speculation, flipping, is on borrowed money that's only increasing. The repayments are only increasing. So that borrowed money is getting far more expensive, and the value is dropping. That's ugly.
It is ugly. And, one of my observations, Tony, having been through a few of these cycles, is that the debt cycle can really get people by the throat. if they're actually caught in the upward move of the interest rates. And of course, that's precisely now what we're seeing. And I don't think that some people have fully appreciated the full impact that this upward rise of rates is going to have, particularly, as you say, fixed rates, which won't hit till next year. So it's interesting that I think there are going to be a number of shocked people around as we move into 2023. One of the reasons why I think property prices will still slide a bit further, and why I think there are going to be sort of higher listings. The debt machine, which is the way that the economy has been built for the last 20 years. It's policy from the government through the Treasury through to the Reserve Bank. Just stoke the debt up and let households over-leverage. The debt machine, I think, is coming unglued. And that means that this is going to be quite uncomfortable for many people. I guess one interesting question is, to what extent do you put that down to personal responsibility? In other words, have people actually just stitched themselves up? Or do you think they've been kidded by government, Treasury, RBA, the property spruikers? Where do you put the weight of blame on all this?
That would have to be one of the best questions I've ever been asked, Martin. I wear big boys' pants now. I look at some of my predicament as 100% my fault. I've got no one else to blame. In my younger years, I thought, on a cop salary, I thought it'd be cool to buy new cars. They just appreciate. That was 100% my fault. I chose to get a credit card and blow it up. That's 100% my fault. If I buy a heap of Tommy Hilfiger online and it comes to me and it doesn't fit, that is my fault. And I think what Australians haven't done is adequately stress test themselves on someone losing a job, someone's health declining, or interest rates increasing. I think there's enough information out there for those to go out and get a 30-year mortgage on rates not going up for 3 years. I don't think they've done enough forward planning. So, when I make a good decision, I'll take credit for it. When I make a bad decision, it's my fault. I've got no one else to blame. And when I was weighing up whether to go variable or fixed on my mortgage, I ignored the bullshit from the RBA. I thought, well, we're at 0.1. Fixed rates are around 2.6%. Which way could they go? And it was a very simple decision. But I chose to get educated on markets, interest rates, fear, greed, speculative bubbles. So I'll take credit for that decision. But again, we all have moments of weakness. And the sad part is that this has extended to falling for the marketing spiel to think that a house 60 kilometres from the Sydney CBD should cost you $1.5 million, and you're going to have 30 years of low repayments. I think families or the major financial decision maker should take some responsibility for that. But you need to get back to the fact that humans inherently are good people. And for many, they've just followed the herd. There's safety in numbers. They'll believe what they read in the papers. A lot of these calls, can be proven correct. But, now it's going to get to the point where to survive, you either sell, you go for bankruptcy, or you try and find additional sources of income. You start to sell the toys. Well, the luxury car markets and the repo markets, it's all starting to crumble. The jet skis, all this crap, the boats, you buy a boat, you go out twice a year. I mean, I guess when the wealth effect is kicking in, as I said, you get these delusions, but I think it's a combination of things. You have to look at interest rate policies. You do have to look at some statements made by Lowe and the RBA, but the rest of it if you've been caught in a speculative bubble, the signs have been there. You need to make a definitive decision, and the banks can certainly help, but you just can't strike off that mistake. And sadly, it's widespread on other people's money. And I guess if you want to lose a friend, lend them money.
Well, that's right. So there's no doubt in my mind that the debt and friends don't work well together. But for me, there's a very important message here, and that is that if somebody's thinking of getting themselves into the situation where they're going to be getting into debt, they should run the counterfactual. What if this happens? What if that happens? And the thing that scares me most is when I talk to people in my one-on-one sessions, quite a lot of people have never thought about those. What happens if something adverse happens? They always, assume the best, assume that everything's going to work perfectly, assume that everything is going to play fair and right. That, I think, is probably where the ultimate mistake lies, because you have to be able to say, if this happens, I do this. You need to think that through before you dig yourself into a hole, I think.
Oh, absolutely. And what I've noticed in watching financial markets and getting to know thousands of people through being their advisor is conservative people tend to stay conservative. They might join the speculative, they might chuck $5,000 at crypto, maybe they chuck $5,000 at the top, or they looked at buying a Trump NFT card or a Bored Ape. But I guess in a way you're kind of born with it and you're conditioned. And even though the marshmallow test has been largely disproven, if you can pass that test at the age of 4, that shows that you can delay gratification and you have a chance of being an accumulator. So it all gets back to our personalities, our level of risk. I've always been a speculator. And I took out that better promotion. We had $30 on France to win $3,000, and I'm sitting there with my son. But my consumer confidence level was at rock bottom. Even when it got to penalties, I felt I didn't have a hope in hell of winning that money. I looked at the game. France looked disinterested from the outset. If they would have won on penalties, I would have taken the money with a fair amount of guilt. But that's the way I am. My portfolio is going to be volatile. Everything I do is volatile, apart from a market that I don't rely on, which is the property market. I need a place to live. It's comfortable. It's safe. I'm not here to be a show pony. But it all gets back to personalities, and what I say to some is, if you're conservative, stay that way. But you do have those in their elder years that maybe haven't built up their superannuation enough, that will use some of their capital to take risks. But the whole country has turned essentially into gamblers. We are gambling on this. Prices going in perpetual motion to be able to sell something we buy to a greater idiot willing to pay more, and it's swept pretty much the globe. So I don't know how we're going to come back from this predicament, but I guess to have these asset bubbles deflate, let's get back to fundamentals. Let's get back to price to income ratios of 6 to 7 times income. Mortgage rates, well, who'd have thought they'd be approaching 7% from where we've come from?
Long-term average, 7%.
That's the norm, where you borrow what you can afford. And that they say, well, just after I was born, Dad paid 3 to 4 times his yearly salary, and we lived in Manly Vale. Terry Hills, now you look at those $3 million prices and it's just out of kilter. Interest rates, the whole cycle is out of kilter, and you eventually revert back to the norm, and heaven forbid you overshoot to the downside. But I can see the sentiment and ramifications of what's happening lasting for potentially decades.
Yeah, absolutely, Tony. Well, we're running up against our deadline. I put up a question in the poll. I'll get you to give me your answer in a second. And the question I put up was, by the end of 2023, the Oz economy will be either in a recession, or slowing but avoid a recession, or improving but rates will still be high, or improving and rates will be lower than now. So of those four, Tony, where would you place your dollar if you were going to put a dollar on it?
I'd say that there's a chance, based on the strength going in with the economy, I'm going to say that we're a chance at avoiding a technical recession with a slowing economy.
Okay. Well, I'll tell you that the poll, we had 225 votes. 66% said we'll be in a recession by next year. 16% said slowing but avoid a recession, which is, I guess, where you are. 12% improving but rates will still be high. And 6% improving and rates lower than now. So I'm going to end the poll there. And I guess that's interesting because one of the things you mentioned was consumer sentiment. And it's interesting that the consumer confidence data from Roy Morgan today was down again. And this, for me, is a very important sort of summation of where we are. At the moment, consumer confidence is as low as it's been for almost ever. And if you want a forward-looking indicator as to what may happen, I think this is where you look. So that's why I think that we're going to have a very difficult 2023. And therefore, I think it's really important that people are cautious about the decisions that they take. And, the fact of the matter is the debt machine is going to grind a lot of people into the ground. Or as you say, sandpaper them to death. So I think time to be a bit cautious, Tony.
Yeah, and I guess probably what I've learned is when things are going exceptionally well, the best thing you can do is eliminate debt on depreciating assets. And that's probably the greatest lesson, because you think, oh, okay, I'm going to borrow money. Why would I pay cash for a car when things are going to go well? I can easily make the repayments. If I just paid cash for one of them, I'd certainly be in a stronger position. But we all stuff up from time to time, Martin, and it's a case of just stuffing up less. But that's my greatest takeaway, is that my goal now is to rid myself of debt and simplify my life, because where we're heading is certainly scary. But I will say that my best investment of this year has been booking concerts that I can't attend or being cancelled. I've had 0% return, but that's better than the minus 50 on some of my stocks.
Tony, I want to say thank you so much for sharing your thoughts again, as always. Straight shooter, but always very thought-provoking, and the comments in the chat have been very appreciative. So thank you very much. Have a great Christmas. I hope that the new year treats you well and better than this year, and we should do this again sometime quite soon. Yeah,
look forward to it, and thanks, viewers, for all your support. We'll get through this. Just I guess focus on your health. I think that's probably your best investment. Self-growth, and load up the popcorn, low salt, obviously.
Absolutely. Well, I recommend 4 walks with dogs daily, which is what I do, and I have to say I'm feeling good on it. Thank you, Tony. Take care.
All right.
Happy Christmas, and we'll see you in the new year.
Okay, look forward to it.
Thanks,
Martin.
Bye-bye. So there you go, folks. Interesting conversation, as always, from Tony. And just to say that the dogs have not moved, still asleep, sound asleep, but there you go. They are looking very, very cozy there. And just to say also that next week there are going to be 2 shows. On Monday, we're going to do a live, this is Boxing Day, a live Monday evening rant with Edwin, and that's going to be at 1800 Sydney time. So join us for that. Boxing Day evening at 1800 6 p.m. And then on the Tuesday, we're going to have our normal live stream. And the last one for the year will be with Leith Van Onselen. And we're going to talk about the property recession of 2023. Is it going to come? How it's going to come? And what the implications may be. So there's 2 opportunities for live shows next week. I hope you have a great Christmas meantime. And thank you very much for taking the time to sit with us tonight and listen to some of the things we've been talking about. I hope you found it useful. Take care. Have a good break over the Christmas period, and we'll catch you next time. This is Martin North from Digital Finance Analytics, signing off. Good night.